Amazon stock has lost more than half of its value this past year, causing investors to wonder, why has it gotten clobbered, and is it now in this deep value territory where it has significant upside potential? I'm going to share my thoughts on Amazon's valuation and why it's gotten clobbered recently. If you enjoy educational investment videos, please make a point of hitting that subscribe button. You are watching Unrivaled Investing. So let's dive into understanding, why has Amazon lost more than half of its value? Is it now in deep value territory? Well, first of all, one should understand the factors that resulted in the current situation, the current circumstances. One of which is you're looking at weaker growth. Management has called out effectively 2 to 8% growth in the fourth quarter, and that is disappointing for investors. Another big disappointment for investors is the fact that their profitability has declined so much in the past year. You can see year to date, their operating profit has gone from $2.1 billion the prior year to $9.5 billion in 2022. Most recent quarter, $4.8 billion to $2.5 billion. So not only are they growing slower, but their profitability is shriveling up. What's going on here? So part of which is you're looking at a weaker consumer. With higher inflation, they have less money to spend on discretionary goods. Another key aspect to consider is that you're looking at higher input costs. This is both from labor, where Amazon hired a lot to deal with the demand from COVID, but now as the economy has gotten back to normal, that sort of, hey, that demand isn't as strong as we were expecting, but we did hire, we did increase our labor, and also we're looking at higher input costs just because of inflation. Let's say higher fuel costs for their global fleet of shipping. So when you look at these different contributors, weaker demand and higher input costs, that does result in sort of squeezing that profitability. Another core aspect that is causing investors to say, ugh, I do not like what's going on with Amazon, is the US dollar. This is not something that's in Amazon's control, but the US dollar has appreciated so significantly in 2022 that what you're looking at is a period where the Amazon's international markets are reporting a decline because the US dollar has appreciated so much. So reporting in US dollars, Amazon's international business is declining around 5% so far in 2022, which investors really don't like to see. They don't like to see shrinking profits and shrinking top line. So you look at all these things, and no wonder investors are throwing in the towel saying, ugh, down 50%. I'd argue what makes this even worse is that they don't have the free cash flow to buy back stock, and that you have cash burn of $26 billion in the last 12 months. Investors really don't like to see that cash burn. And it's not like you have a super clean balance sheet. You have a balance sheet with roughly the same amount of cash and debt. So they're not really in a position where they could say, hey, we see this weakness in our stock price. Let's go all in terms of buying back stock on the cheap. And that's personally what I want to see with my top holdings. Is I like the fact that as the stock price goes lower, they are in a position to buy back more stock. And that's, what I call out to my subscribers at Unrivaled Investing. And so how do you value Amazon? Well, it's actually really tough. Management sort of obfuscates, what is their true profitability and what's actually driving their business. I mean, you have online stores, you have physical stores, you have third-party seller services, thinking about fulfillment services for the merchants that sell on their platform. You have subscription services. Think about Amazon Prime. You have advertising. You have AWS. AWS is the only of these various different business lines where management calls out their profitability. Everything else, it's really unclear how much and where the profit is and where their losses are and where they're investing. And this is what makes valuing Amazon so tough, is because they don't really do investors any favors by saying, hey, these are our business lines, but they don't really show their profitability. And if you don't pencil out, hey, this is where our profits are and this is where our free cash flow, it makes it harder to think, oh, okay, well, the valuation is this because you have all this free cash flow you can divert. And once again, when I'm looking at my personal investments, I want to see that free cash flow, because I say, oh, okay, what are you going to do with that? Are you going to use it to buy back stock? Are you use it to return to shareholders? Amazon's, historical track record is to take all their free cash flow, reinvest it in the business, so that way you don't see that free cash flow. So it's harder to see. And only times of real extremes like the last few years where they really start printing free cash flow, then you go, wow, this is an incredible business. So where does Amazon stock go from here, given this dynamic where they obfuscate the results, the stock's down 50%, and you have several headwinds impacting their recent results? Well, first, if you're looking to take charge of your investment journey, consider unrivaledinvesting.com for compelling investment ideas, real-time portfolio updates, and our exclusive Discord server available for annual subscribers. I also recently launched 2 new investment courses for enterprising investors, so those that want to learn more about analyzing financial statements, and also for those that want to learn how to value stocks, thinking about valuing stocks like Amazon. If you want to take the next step in terms of thinking about the components that go into valuation, I launched those 2 courses. Once again, this is not financial advice. So thinking about Amazon, you could sort of look at it as a 3-legged stool, one that you could even buy on Amazon. So this is one on the Amazon website. So the 3 legs are their North American segment, their international business, and Amazon Web Services, which powers much of the internet. AWS, or Amazon Web Services, that is a key component where one could argue, based on various different inputs, that it should be worth somewhere around $1 trillion to $1.8 trillion. So this is interesting because I'm effectively saying, based on their current profit margins and based on their existing growth, they're growing over 30% this year, assuming a discount in terms of their growth rate in the years ahead, maybe closer to 20%, maybe closer to 25%. I'm giving them a full multiple, around 25 times earnings, partly because this is such a stable and such a necessary business. This business empowers, hundreds of thousands, if not millions of customers around the world that enables web businesses. This AWS is an incredible business. They pioneered the space, the cloud space. And so you're looking at just this business. You could say AWS could be worth somewhere between $1 trillion and $1.8 trillion, which is more than where the stock currently is. And I'm effectively saying that AWS in the low side could be 125% of the current market cap. So over the next 5 years, AWS could say, hey, ignoring everything else that's in Amazon, ignoring their significant online retail operations, just focusing on their AWS segment, their cloud business, you could have 25% price appreciation in the stock on the low side. And the high side, just on AWS, you could have over 100% appreciation just from their AWS segment. Once again, ignoring the entirety of their retail operations, which is obviously quite significant, has a huge market share. Once again, this is a hypothetical valuation framework. If they do not execute, if their performance looks a lot worse than this, if their margins deteriorate more than what I'm sort of penciling out, currently their margins are around 30%. I'm saying 28% in my low case. I'm assuming 32% in my high case. We'll see. If they do not execute, then I would expect the stock price can go a lot lower because this framework wouldn't hold up. But if they execute and the results look similar to this, it wouldn't surprise me to see a situation like this. Of course, stock price can go way higher, way lower. So then let's put all these pieces together. I shared the full valuation framework for my subscribers at unrivaledinvesting.com. So how should you think about, let's say, their North American ops or their international ops, which once again includes all these business lines that make it tough to value. So looking at these different components, I say on the low side, around $350 billion, on the high side, close to $700, $800 billion in valuation for their North American and international ops. I get that, and I share, once again, the detail to my subscribers. The detail is effectively based on low percentage operating profit for these different segments, whether or not it's North America, maybe you get 5, 6, 7%, maybe international, you're closer to 3, 4, 5%, and some sort of growth rate. North America, maybe looking at high single digits, low teens, international, lower growth rate. So looking at those components, looking at adding all of them up, factoring in the fact that, Amazon has a sizable debt burden, it's around $60 billion, I believe. You look at these different components, add them all together, and I'm penciling out roughly 60% upside on the low case, and once again, closer to 200% upside on the high case. Now that is quite an interesting setup. This looks quite compelling. The question is, how can you be comfortable with the low case scenario? Because the AWS, I already talked about, you're assuming lower margins, you're assuming 20% growth over the next 5 years, which is a significant discount from their 30% plus growth. So how can we get comfortable with that $350 billion for their retail operations, everything, their Amazon core business, their legacy business that they built? Well, it's interesting. Going back to their different business segments, their business lines, advertising alone is effectively a $40 billion revenue business growing at 25%. I think this year it'll be closer to 36, 37 billion. Next year it'll probably be closer to 43 billion ballpark. These are guesstimates. This is a high margin business. Advertising is an incredible business. So I'm assuming, 35% after tax margins for this business line alone. This gives no credit to, let's say, Amazon Prime. This gives no credit to their, investing in their all these feature films and TV shows and terrible Lord of the Rings spinoffs and all that sort of stuff. I'm not giving any credit to that. I'm giving zero credit to that. I give zero credit to their cool new stores where you can just walk in and, you don't even have to check out a cash register because it just watches what you're doing and says, oh, this is how much it costs. Giving zero credit to the fact that it's their online business is amazing, just focusing on their advertising business. So not even factoring in all the goods that they sell where they take the inventory and sell it, just the advertising where merchants spend advertising money. So that way they are shown when you go shopping. That is $40 billion revenue. And assuming a 25 times multiple, assuming 35% profit margins, that is worth $350 billion. So I think you can say on a very reasonable basis, on a low side, that their non-AWS business could be worth $350 billion. And then their AWS business, you could comfortably say, based on what I just talked about, that could be worth $1 trillion. So that gets you in that, once again, that low case scenario to that 60% upside over 5 years, maybe a 10% annualized return. Once again, this is a hypothetical framework. It depends on their execution. If they don't deliver, stock price go a lot lower. If they deliver, though, and they start proving out real profitability, in their segments and not sort of the, obfuscation of, oh, well, maybe our profits are zero, or, we're actually consistent free cash flow. That's what investors love to see. Then I think you see a situation where it's closer to 700, 800 billion. You have 200% plus upside. So I overall look at Amazon and do think it is closer to that deep value territory. I do like what I see, but I'm also very mindful of the macro environment where you continue to have Fed tightening, you continue to have a weak environment. So I am very aware of this. And that's part of the reason why I haven't, let's say, gone all in on Amazon stock. So I look at this and I go, wow, this is quite promising. And I think the way investors should consider this is say, hey, do I have investment ideas which I think are more compelling than, let's say, Amazon, which I'd argue is a very strong, if not unrivaled business in the e-commerce space, and quite possibly the cloud business where they're the top player. You have Amazon, you have Microsoft Azure and Google growing slightly faster, but still top dog, really 3 contenders. So I look at this and I'm thinking, incredible business. The way to look at this, I think, is to say any new investment I'm making, does it meet or pass the Amazon hurdle? Because if it's not meeting or passing this Amazon hurdle where you can buy these exceptional businesses with, let's say, 60 to 200% upside over the next 5 years, then I'd say, hey, it's probably better just to buy Amazon. But if you're looking at something and you're saying, I think there's 200, 300, 400% upside, that's when you're saying, okay, that's passing the Amazon hurdle. Now I'd consider deploying that capital. And so that's where I think investors can really benefit from using Amazon from a hurdle rate perspective, and otherwise say, hey, why not own Amazon if my new investments that I'm looking at don't meet that test? And one example of which of something that could do better is the company that does have the free cash flow. So if you have a company where you're saying, hey, I think it has the same sort of risk upside, but it has that free cash flow and they're going to be able to buy back stock. That is something that I'd say does have a leg up over Amazon, because you're saying, well, even if there's a terrible recession next year and the stock price continues to fall, well, at least this company is going to buy back 10% of their stock or 5% or 20% of their stock because they have that free cash flow. Amazon doesn't at this point because they're still reinvesting in the business. And investors don't like to see, hey, you're reinvesting so significantly in the business, but you're not growing that fast. 26 billion cash burn to talk about only 2 to 8% growth. That does not get investors excited in the short term. Long term, I think you are able to get attractive returns from Amazon if they continue to execute like they've done historically. Currently, they're facing a number of issues. Long term, I think their value and brand probably hold up. They have several competitive advantages. So if you enjoyed this video talking about Amazon, thinking about, what's the valuation? How do we think about valuing these different components? Please make a point, hitting that thumbs up, hit that subscribe button. Thanks so much for watching Unrivaled Investing.